Okay, so we have an exercise that we're going to look at, and it is titled Preparing a Statement of Cash Flows via the Indirect Method. Okay, so this is not exactly a piece of cake. One thing I do want to warn you about is I'm going to have to move the screen around a little bit as I do this because as you can see, there's quite a bit of information that we have. This is our area right here where we're going to be working. Okay, and so let's go ahead and get started because we've got a lot to cover. It says the following financial statements were issued by Hoskins Corporation for the fiscal year ended December 31st. Okay, and all amounts are in millions in US dollars, and we really don't care about any of that. It could be in euros, it could be in pounds, it could be in actual dollars. In other words, they might only have $300 cash. We really don't care about any of that because it's not going to impact what we're doing. Okay, but we have their balance sheet here, and this is what we call a comparative balance sheet. We have the dates. We have the balance sheet as of the dates December 31st, 2018, and then we also have December 31st, 2017. So it's very, very important because we are going to have to use the balance sheet. Very, very important that we recognize which date is done is first. So 2017 is to the left and 2018 is to the right. And so, what are we attempting to do? Well, we're attempting to determine what the true cash flows were for operating activities, investing activities, financing activities for the year. Okay, so indirect method is a little harder, but it is the method that is best to use. Okay, so we have our balance sheet here. Those, again, assets from current to non-current, liabilities, and then we have our stockholders' equity section down at the bottom. Then we have an income statement. Notice the income statement is only for the year 2018. And then in addition to all of that, we have some additional information here. It says, we've got 1, 2, and 3 items, okay? And they wouldn't be giving us this information if we weren't going to use it. So it says, prepare a statement of cash flows, all 3 sections, for Hoskins Corporation's fiscal year 2018 using the indirect method for the cash from operations section. Okay, I guess we can do that. So what we always want to do first is we want to start with net income. This is always the spot that we want to start with first. So let's look at our little drop down box and find net income, and we go up to our income statement. We've already calculated it. Okay, so net income is always going to be our starting point, and quite honestly, we should probably just use the rest of the income statement. So let's look at the income statement, and we've got a lot of every item on here is fairly common item. Start off with our revenues. We have cost of goods sold. We subtract cost of goods sold from revenues. We have our gross profit, and then we have our operating expenses. However, this one right here, depreciation expense, this is a non-cash expense. So it lowered net income by $350 because it's an expense. But there was no check written to depreciation expense or anything like that. So this is going to be our first adjustment, and we're going to come down here, find depreciation, and this will actually be an addition, right? So one thing I would also say is we kind of have to think backwards whenever we're doing a statement of cash flows, because we're trying to work back again to the amount of cash. And so if our starting point was net income and depreciation, a non-cash expense, lowered net income by $350, then this is going to be an adjustment where we have to add that back in. Notice that after depreciation, they give us some balance sheet accounts. Looks like 3 current assets and a liability. So we're going to have to utilize the balance sheet for these, and it is up here. And the first item that they gave us was accounts receivable. And so notice, again, at the end of 2017, our accounts receivable balance was $600. Well, now it's $1,500. So what that means is that there are $900 in sales net over the course of a year. $900 in sales, additional sales, that have not been collected in cash. So even though our receivables went up, what we're going to do is we're going to handle this in the opposite manner. And so what we're going to do is we're going to type in negative 900 here. Okay, accounts receivable went up, so the impact to cash would be a downward effect. In other words, of all of this sales revenue right here, there's a net 900 that has not been collected in cash, because remember, we are using the accrual basis of accounting. So we recognize revenue when it is earned, not when it is collected in cash. So we have to make that adjustment because there's $900 out there that we did not get in cash. All right. Next item they give it to us is change in inventory. So let's come up here and grab that. Inventory was 400. Now it's 500. So we're going to do the exact same thing that we did with accounts receivable. So what we're saying here is there's this, all we have to recognize is that there's $100 in the gross. These are in millions, but again, that doesn't matter. There's $100 more we spent on inventory essentially than what we needed to. So this $100, $100 cash, or in our case, $100 million in cash that is not there. So we're going to do the exact same thing, and we're going to enter a negative here. Okay. And then we have a change in prepaid expenses. Now, prepaid expenses are assets. These are items like supplies, insurance. We could even have prepaid rent. So we're going to go up here to prepaid expenses, and we're going to see that they were, at the end of 2017, $400. Now they are $150. So the asset has gone down. Well, a prepaid expense or a prepaid asset is what we call a deferral. It is a deferred asset. We pay the cash up front, and then we expense the item as we use it. So what we're saying here is essentially that there's a net $250 that has been expensed because either supplies have been used up or insurance has been used up. And so this $250 spread here is very, very similar to this $350 in depreciation expense. It is, let's see here. Well, it looks like it's going to be buried in this $1,450 here, so we can't see it. But this is a portion of this $1,450. $250 of that is non-cash. So we're going to go down here, change in prepaid expenses. It went down, so that means that the income statement has been expensed by $250 that too much, that was not in cash. And then finally, let's see here. We're going to go up here And the next item that I saw on down below was accounts payable. We don't have to worry with these long-term assets, generally speaking, because these are investment items. Okay, so we're going to skip past those for now because we're working on the operating section of the statement of cash flows. So accounts payable is our next item. And so we went from $400 at the end of 2017 to $800 at the end of 2018. And this is about the only good news we'll ever get with liabilities, is that whatever the change is here, we enter it the same way on the statement of cash flows. So think about it. When we incur certain liabilities, I'll just use payroll as an example because that's a pretty good one. We recognize that expense when it is incurred, you know. And so we have driven up liabilities here, but that's $400 in cash that we have not actually paid. We might have expensed it, but we have not actually spent that cash. So let's go all the way back down here to change in accounts payable, and we're going to enter that change exactly the same way. Okay, so we've got our change in accounts payable, and then it looks like we have one more item. So a little bit of a hint here, because we have moved past our assets, our current assets, and we're now in our current liabilities. Looks like we have one more liability that we have to account for, because cash flows from operating activities is our next item. So let's go back up to the balance sheet and see if we can find that. Okay, so we have income tax payable. And at the beginning of at the end of 2017, it was $200. Now it's $100. So it's gone down by $100. And again, with liabilities, we enter it exactly the way it is. With our expenses and our assets that have a normal debit balance, we have to reverse that, but we don't have to do it with our liabilities. So let's see here. They want us to find that. And let's see here. Change in income taxes payable. There it is. And so this is actually going to be, it went down, and since it's a liability, well, then we can just enter it exactly the way that it is. So let's see here. I've got something on my calculator right now, so let's get that back over here. So we're going to calculate cash flows from operating activities, we're going to start with net income. We're going to add back depreciation. Let's see here. We're going to subtract out the increase to accounts payable. We're going to subtract out the increase to inventory. We're going to add back the decrease to prepaid assets. We're going to then add the increase in liabilities. And finally, we're going to subtract out the decrease in income taxes payable. And so when we do that, we end up with $600 million. So we started off net income $700 million, but what we wanted to know was what was our overall increase or decrease in cash from operating activities. That answer is $600 million. Okay, so I think what we're going to do is we're going to go ahead and end this video, and then we'll try to get investing and financing activities in the subsequent video.